Welcome back to The Explainer, everyone! Today, we're tackling a massive milestone for literally any physical business. Just imagine you're running a growing construction firm, a sand and gravel operation, or maybe a forestry company right here in Saskatchewan. You've got the contracts, you've got the vision, and you are totally ready to scale up. But to actually pull that off, you need two fundamental things. First, the heavy machinery to do the work, and second, a physical home base to store it, maintain it, and run your operations out of. We like to call this the blueprint for physical growth, your gear and your ground.
Okay, let's dive right into this. If you're a business owner ready to take that next big leap, what actually stands in the way of getting your new machinery and the shop space to house it? You know, you might think it's just a matter of signing some papers and shaking hands, but the reality is way more complex. The two absolute biggest hurdles are navigating the deeply misunderstood world of commercial equipment financing and surviving the total minefield that is a commercial real estate lease.
So here is our roadmap for the Explainer today. 1. Decoding equipment loan rates. 2. Finding flexible financing partners. 3. Navigating commercial leases. And 4. Protecting your business space.
Part 1. Decoding equipment loan rates and the true cost of gear. When it comes to financing a new excavator or a whole fleet of haul trucks, most folks just assume their credit score is the ultimate deciding factor for their interest rate. But looking at the latest 2026 data from Iron Finance, we actually need to debunk that myth right now. While your credit score definitely matters, the big revelation here is that the specific category of lender you apply to dictates your rate far more than your credit score ever will.
Now, what's really interesting about this is how distinctly the Canadian market is segmented in 2026. Just look at these buckets. If you go to traditional banks or captive finance arms, you're looking at the 6.5 to 10% range. Dedicated equipment finance companies, they sit right in the middle at 8 to 14%. And private lenders, who step in when the banks decline a file, range from 12 all the way up to 22%. So looking at this, you really have to ask yourself, which rate bucket do you think your business actually falls into based on your timeline and the age of the equipment you're buying? To really put that into perspective, the exact same contractor with the exact same 660 credit score buying the exact same piece of equipment could see a 6 percentage point difference in their quoted rate, literally a 6% swing, and it's not because their financials changed, but simply because they applied in the wrong lender category first. Falling for a low headline rate at a bank when your specific file actually belongs in the equipment finance bucket can cost you crucial time and ultimately lead you down a much more expensive path. Moving on to Part 2, finding flexible financing partners beyond the banks.
So, what happens when traditional banks say no, or when their rigid structures just don't fit the reality of a seasonal, resource-based business? Well, this is where direct, localized lenders step into the picture. Let's look at Essex Lease Financial Corporation, for example. They're a direct lender supporting Western Canada. You see, traditional lenders often just stare blindly at a balance sheet. But a specialized equipment partner looks at local market conditions and true business potential. Essex Lease focuses directly on the core drivers of Saskatchewan's economy, things like sand and gravel extraction, forestry, booming construction hubs, and heavy transport. They fundamentally understand that a logging operation in North Battleford operates on a totally different rhythm than some tech startup in Toronto.
And that rhythm dictates the terms. Because they're direct lender cutting out the red tape, they offer incredibly flexible term limits, typically ranging from 24 to 84 months. But here is the real game changer. For agricultural or resource-based businesses, they can actually structure your payments around your seasonal cash flow cycles. If your revenue freezes when the ground freezes, your equipment payments can be customized to match that exact reality.
And you know, you don't just have to take my word for it. Here's some real-world social proof from Curtis Berthelot of PSI Mining Inc. right in Saskatchewan. He notes that a great asset lender provides a sincere partnering relationship, one that offers not just capital, but sound advice for capital-intensive growing companies. That right there is the key difference between a purely transactional bank loan and a true financing partner for your gear.
All right, Part 3, navigating commercial leases and securing the space.
Okay, so you've got the machinery financed. Awesome. Now we pivot from the gear out in the field to the actual ground. We're looking at some commercial lease drafting checklists provided by the Law Society of Saskatchewan. And let me tell you, a commercial lease is nothing like renting an apartment. It is a high-stakes, deeply complex legal document. It's so much more than just a monthly rent payment. This is a contract that can fundamentally dictate exactly how you are allowed to run your business day to day. For example, let's talk about a concept called percentage rent.
In a lot of commercial leases, landlords require rent that's calculated as a portion of your gross sales, and this is often layered right on top of your basic minimum rent. So it literally means the landlord is taking a cut of your operational success.
But honestly, it gets worse. Let's look at how this builds into severe operational restrictions. Because the landlord gets a cut of your sales, they basically become your unwanted business partner, and the lease will strictly obligate you to maximize those sales. You might be contractually forced into continuous operation, meaning you're forced to stay open during specified business hours regardless of your staffing realities. You're forced to maintain adequate stock. They can even slap you with a radius clause, completely prohibiting you or any related company from opening a similar operation within a certain number of kilometers. Your daily business management is suddenly legally tied directly to the landlord's revenue.
Which brings us to part 4, protecting your business space from hidden costs and liabilities. This is the most critical part of our blueprint today, protecting yourself from liabilities buried deep within the agreement. Take a look at the standard legal definition of operating costs that a tenant is expected to pay. It includes all costs of operating, maintaining, repairing, replacing, rebuilding, insuring, supervising, and administering the property. So the crucial point here is just how broad this definition actually is. If you aren't careful, you aren't just paying for snow removal and hallway lights, you could be legally on the hook to pay to rebuild the landlord's structurally defective roof. Yeah, really. So here is your step-by-step action plan to protect yourself. First, meticulously review those general inclusions. Second, and this is highly important, you must aggressively negotiate exclusions. You need to explicitly exclude things like the landlord's capital costs, depreciation, interest on their debt, and inherent structural defects from your bill. Finally, strictly calculate your proportionate share based on exact square footage, ensuring you absolutely aren't subsidizing unleased empty space in the building.
Now here's another massive hidden risk pulled straight from that Law Society checklist. You need to check if the landlord has the right to expand, relocate, or change the leased premises before or during your term. Just imagine sinking thousands of dollars into customizing your shop floor, only for the landlord to exercise a relocation clause that forces you to move to a totally different unit entirely just because they found a bigger tenant for your space. You must secure remedies and compensation for material changes like that.
Finally, the lease is going to legally mandate a really dense web of tenant insurance. You're going to be required to carry all risk insurance for your stock and improvements at full replacement cost. You'll need general liability, legal liability, and business interruption insurance. And you will almost certainly have to provide waivers of subrogation. This essentially means your insurance company cannot go after the landlord if the landlord's negligence damages your property. You are entirely responsible for protecting the landlord from builder's liens, property damage, and overall liability.
So after peeling back the layers on equipment financing rates and the absolute legal minefields of commercial leases, we have to ask the big question. Is your business truly ready to secure its gear and its ground? Scaling up your physical footprint is incredibly exciting, for sure. But as we've seen today, success requires looking way past the headline interest rates and the basic monthly rent. It requires finding the exact right lender for your specific industry rhythm and bringing a microscope to the liabilities hidden in your real estate contracts. Thanks so much for joining me on this explainer. Stay sharp out there and happy building.